Hey guys, I've got more SpaceX for you. Today we're going to talk about LEAPS on SpaceX. If you caught the last video, you saw I went through a whole process of building a collar trade with SpaceX, which gives you very low risk. You have a floor, can't lose below that floor, etc. I think there will be a link down here for that video. If not, it should be the one before this video. Very cool. But we're going to take a different turn today. I had a lot of requests to do a video on LEAPS, and so we're going to look at LEAPS on SpaceX and how to play that. Now, one of the things about SpaceX is we don't have a lot of data on SpaceX or chart or info or anything, right? Now, it IPO'd at 135 and then it picked up here 225 and then it's been down, down, down. Good earnings, and now we're kind of off to the races here. So we want to try, we want to play this thing long. I think it goes higher, does great things over time, given some time, and maybe much higher if you look at the numbers, right? But what I want to do, let's look at some leaps. Again, we'll go over here to our trade tab. Now I am using TOS, Thinkorswim on Charles Schwab here. So we go to and all brokerages are set up basically the same. So I'm going to go to our options chain, and what a leap is, if you don't know, let me start there. A leap is a long-term equity anticipation security. Sounds kind of fancy, right? Long-term equity anticipation security. LEAPS. They've been around for a long, long time. I've been trading for close to 40 years now, 38 years. And they were around, way back then. But basically, all that means it's an option on a stock that's over 1 year, 1 year in length, right? That's generally how that works, right? Now, as you can see, we've got we're at August right now. We've got September 26, December 26. We go to 27 out here. January 28, June 28, December 28. So that 855, that's 855 days from now. So you can go all the way out, as far as you want to go. And that's the cool thing about options, that you can mix and match and kind of create exactly the outcome that you want to have by using options. And if you don't know how to do that, I've got a lot of videos on the channel about that. I love to do that, and I'd love to help you. So with that, let's jump right in. Again, at the end of this video, you'll know how to do this. So let's look down our option chain, and I'm going to do some kind of generic way of explaining this, and I think that would be more helpful. But generally speaking, let's go out a year, right? Now a year, let's look down our option chain here, and we'll go down here. We can do it one or two ways. These are the days to expiration, so we can go 365 days, it's going to be somewhere between there and there. Or we can say there's June and there's September. Let's just go to September. That's 400 days from now when I am recording this video. And we'll scroll this thing up right here and look. Now this is our option chain, and basically you can see out here there's already, so this far out in time, there's already 4,000 contracts there, there's 1,400 there, there's 1,900 there, there's 2,000 over here, etc. So people are already putting money that far out in time. I think that makes sense, right? Also, in that prior video, I showed how my AI platform identifies some of these option chain kind of unusual option activity, and I'll try to put a link down there for that too if you want to check that out. But the AI that I used to do that. But let's go out here, and generally speaking, if we're closer in, meaning we're 30 days out or something like that, we kind of like to, if we're going to buy calls, we want to probably be around a 70 delta. This is our delta. If you don't know what that means, don't worry about it. Basically, that gives you, if you bought a 70 delta, that gives you about 70% of the movement of the stock, right? That's basically what that means. For a longer term like this, I like to go deeper in here and go to about 80 delta. And actually, I'm going to go to a 78. It's not an exact science. That's one way to do it. That's the way I prefer to do it. I managed by the Greeks, and you can really get a lot more specific that way. The other way you can do it is to say these options right here, if we're going to buy these call leap options, they're going for $53 to $57 per contract. So you may say, you know what, that's a little expensive for me. I'm going to go up here and spend less money, but there are give and take reasons for that. I would rather stay here, even if I have to pay a little bit more, somewhere around this area between 70 and 80. I'd rather stay there because of theta decay, and it just works better over time. But let's do a little quick cost comparison here. So we know I like this one right here, and we know this is going to be, if we're going to buy these options, let's say we can buy them at the mid price there, $55.50. I'm just going to take these over to my trusty Analyze tab. The Analyze tab is amazing. It helps you visualize these trades and all that kind of stuff. So if we look at this and we bought 10 contracts, right? That's $55.50 times 10 contracts. That's $55,500, right? 10 contracts. Let's compare that real quick before we go any further. Here's the stock. Right now it's trading at $141.58, right? So let's compare that. If we're going to buy, if we're going to buy this, 10 contracts represents 1,000 shares of stock, right? So I'm going to move this to 1,000 just to compare. We're going to compare apples to apples because one option contract covers 100 shares, right? So 10 contracts covers 1,000 shares. So if we're going to buy 1,000 shares of stock, obviously at $1.41, it's going to cost us $141,000, $141,550 to buy that. That's pretty expensive, right? Unless you're trading a very large account. So we could stay here and spend $55, or we could buy 2.5 times more, 55, 141, about 2.5 times more volume by using these, right? And I'm just, just heads up, apples to apples comparison, right? So that's the first step. And so this strategy that I'm going to show you, the LEAP strategy, is called a poor man's covered call. So basically, you could straight up buy the LEAPS here. I'm going to show you how to enhance this even a little bit more. And, we're going to keep that in mind as far as buying the stock, but we're going to do something cheaper. And again, this is a way that you can do this 2.5 times less expensive than outright buying the stock. So, and let me pause right there for just a second and show you guys, and I'll take this off. This is the collar trade that I did last time. Sorry, I meant to take that off, but I don't want that to distract you. I did this in the last video, and it's up about $2,500, but I'm going to take this off for right now. And we're just going to compare these two. So I'm going to move this down, and we'll get back to our regularly scheduled program. All right, so right here, we've already looked at this and go, I don't want to spend that much. You might not even want to spend this much, but I'm going to show you how to do this a lot less expensive. So we come back over here. Now this is going to be the base of our trade, is to have these LEAP options going out 400 days in time, right? So what we want to do, I want to come back over here and go out about 30 days, kind of roughly. We could go a little further out, a little closer in, but let's just go here to 18 September. And I'm going to sell I'm going to sell a covered call against the LEAP option. So the call LEAP option is our stock surrogate, right? So we're going to replace the stock with that, and then we're going to simply write a covered call on top of it. So if you remember, we bought our LEAP down here, in the 70, 80 kind of delta. We're going to sell our covered call up here in the 30 to kind of 20 delta. Again, if you don't know the deltas, I have a ton of videos out there, and let me know. I can obviously do another one on this for you about the Greeks. I'm a big fan of using the Greeks. So I'm going to go all the way up here to a 20 delta. You can see there's a lot of volume. This was today, so this is open interest. This is volume. Somebody traded 13,000 contracts today, but we're going to sell this against our LEAP option. So we take this, and we're going to take this over to our trusty Analyze tab, and there's what our trade looks like. And this is your poor man's covered call. Now, we also got to do a little math here. We paid $55.50 for this, and then we got paid. This is a credit in red. We got paid $3.15, credit to sell this, right? So that gives us 50, what is that? 52.35. Yeah, 52.35. So we're getting a little bit cheaper price because we're shaving off some of the cost here, right? But the beauty of this is that now we have a covered call. Essentially, we have a covered call. This is a poor man's covered call because we don't want to spend as much money. Our strike is 175 right there for September. So by September, if we're sitting right here, or actually above that 175, we will get called away, quote unquote, called away, right? That will give us a, you see over here, that will give us a $28,000, almost $29,000, $28,868 profit on our trade, which costs 52, what was that, 52, 35. So we make 28,000, let's say 29,000, it's 28,886, I believe, on 52. So that's a 50%, that's more than 50% return on our money in 36 days. So would you like to make 50% money, 55% actually, 55% on your money in a month, essentially? Yeah, that's pretty good. So if this gets called away, no problem. High five, that's a win, right? And we do it again. Or if we want to get a little fancy with it, which is easy to do, and we start going up higher and higher and higher, and we say, you know what, we like to own this leap, we want to be involved in the stock, we buy the 175 back and we move it up to 185, and that gives us a little more wiggle room. And we could also move this from September to October, perhaps. A lot of really cool, interesting ways, very straightforward. Again, we do this stuff all the time in my trading room. There's a link down there if you guys want to check that out. I think there's a link for a free, I think it's 7 days or maybe a month. But anyway, check that out down below. But you can always, move this up. But it's kind of my preference to let this get called out and just make the money. I mean, are you going to be upset if you make, in this case, make 28,000 and you've only got 52,000 invested? No, that's pretty good. That's in a month. In theory, you could do this 12 times a year. It doesn't always work out that way, but that's the plan. On the downside, if you say, you know what, my trading plan, you got to have a trading plan. I can help you with that. But my trading plan says that I don't want to lose more than, let's say, 10% on a trade. So that's, we got about 52,000 in this trade. So we don't want to lose more than about $5,200. So all we have to do is hover our mouse over here. You see it's going negative because we're losing money if it goes down. So $5,200 is about right there. If you look down that white line at the bottom, that's $132.90. You see that at the bottom of that white line. So that could be your stop loss at, say, if it breaks $132.90, $133. If it breaks that, I will just close it. I'll just be done with the trade. It didn't work, right? It's one way to do it. Pretty good trade management. And if you said, $50,000, I'm not going to put $50,000 in one trade. Okay, let's do it. Let's size this down a little bit, and we'll make it a little more reasonable. In a lot of these examples, I will have, all kind of different sizes. I don't know what size accounts people trade. If you're trading a $10,000 account or a $100,000 or a 10 million, everything's relative, right? So in this example, so this would be, let's do it even easier here. Let's do one contract. So that's $5,500 minus 300. So you have $5,200, a little over $5,000 in this trade. If it goes up here, you make 2,800 on 5,200. The math is the same, right? Much smaller trade. Then you stop yourself out down here at $500. Kind of was it 132? Yeah, something like that. The math works the same, so you could size it up or down. So that is a real quick version of a poor man's covered call, formerly known as a leap, and how to do it. Again, you could just straight up buy the leap as a surrogate. That's what the chart looks like. That's your risk, and you just let it run, and it just goes and goes and goes, right? Or you try to sell something against it. And the other thing that I was going to mention here, or I will mention here, is that if we're, I don't know, let's pick a point. If we're right here, right? You could take the win. You'd have a pretty good profit there, etc. Or as long as you're not over $175 on 18 September, you keep that full profit, $3.15. That's yours. You keep it. Everything's great. And then you go, you know what? I like that. I'm going to do that again. So I'm going to go out to October, and let's say we're close. So let's say we're up here. I'm just picking a number. And October, and we say, well, we don't want to resell at 175. We want to go out to let's go to 195. Now, at that time, that would be about 30 days out further. We get another $3.15. Maybe you get $3.65. Maybe you get $2.95. It will vary, depending on volatility and such. But the point is, you can do this again. And then if you don't get called out, you do it again for November, and you make another $3, and then you make another $3 in December. And if it does keep going up in a slow, methodical way, you can move the strike price, that price, right? Move that up to 200, move it up to 205. You can keep kind of staying out in front of it. And the whole time you're reducing this cost basis by, let's just say, around $3 a month, and you just keep selling, keep selling, keep selling. Pretty cool way to do it. You're offsetting, you've got positive theta. You're offsetting any kind of theta decay of a long option. So that helps. That helps a lot. Let me show you. This is the option by itself. And as you can see, I don't want to get into the Greeks too much, but it's got negative theta. Now when you sell something against it, now it has positive theta. This is your friend. You want positive theta, right? So that's how the poor man covered call works. Let me know your thoughts. Let me know what you think. I can go into more detail. I'm just trying to kind of do a very broad idea, concept of how that works. And I will keep these videos coming. Just let me know what you want to see. Again, check out the links in the below. Of course, like and subscribe. We like to do that, obviously. Join me in the trading room. I've got a free newsletter where I'll give 3 stock ideas a week. There's a link down there. That's free. That's really good. I put a lot of effort in that. So try to check that out. And also I'll put a link down for my AI. So anyway, with that, let me wind it up. Let me know if I can help. Join me in the trading room, and we will go from there. Thanks for your time. I appreciate it. Take care.